Well, welcome. As I said, this is our 7th webinar in Partners Wealth Management series. This is called High Net Worth Portfolios, Do the Little Things Right. We are very happy you're able to join us. My name is Cheryl, and I'll be moderating today's session. Before we get started, I'd like to just familiarize you with a few details of this virtual space. You'll notice that only our presenters' videos and mics are on. We're going to leave it that way and leave everybody muted throughout the presentation. For your best viewing experience, if you don't see the presenters and the slides right now, you can click on the view icon in the upper right-hand corner of your Zoom window and choose Gallery View. I'd like to encourage you to ask questions through the Q&A portal. Throughout the presentations, we're not going to use the chat. We're going to use the Q&A. So look for that at the bottom of your screen. If you don't see the Q&A button, just run your cursor down there toward the bottom of the screen and it should appear. I'll make sure as many of those questions get answered toward the end of the presentation, if not in the middle, on topic. But if we run out of time, we'll make sure to follow up with you if you share your contact information, and we'll make sure those questions get answered. We are recording this session if all goes well, just so you know that, and we will have that posted on our website for future access. And now I'd like to introduce John Freiburger. He's the founder and managing partner of Partners Wealth Management. As an experienced certified financial planner, John's passion is helping his clients grow long-term sustainable wealth. John works with the rest of the Partners Wealth Management team and a network of experts to partner with individual business owners, high net worth individuals, and corporations, helping them gain financial independence and achieve their goals. Passing it off to you, John.
Thanks, Cheryl. Good morning, everyone. Thanks for attending. We're very excited to have some conversation here that I think you'll find very, very relevant. And our speaker, our expert today, is Angelo, and he has over 20 years of experience in the business. There's quite a few designations after his name: chartered financial consultant, chartered alternative analyst, certified financial planner, and he also has his MBA. And we've had the honor of working with him for a good number of years here. And as part of our series, we thought this topic would be very relevant. So, Angelo, I'm going to turn it over to you now.
Perfect. Thank you, John. Good morning. Really appreciate everyone taking the time to join. Also, thank you, John, for the opportunity. I've worked with Meeder Investment, been with Meeder 7 years, and previous background was with Morgan Stanley, Smith Barney, as well as Hightower. Worked in a small family office, and many clients, I always like to say, have unique risk and unique needs. And the goal was, how do you build out that portfolio? How do you accommodate those needs, unique needs from each client? And that's what we'll talk about, really flipping over the traditional portfolio management approach. Rather than already having a model that's pre-constructed, let's understand the client first, then build the right allocation. I'm going to touch on our approach at Meeder and really how you start thinking about those higher net worth portfolios. Before we get started, I was going to talk briefly on the market. Just given the recent volatility, let's start what we're seeing today, how to be thinking about portfolio positioning. We talk with many different advisors and many different clients. And I can tell you right now, there seems to be 2 different approaches that advisor clients are taking today. And provide a little levity to the situation, but I think it's very important to recognize whether to act on emotion or to act on data. And I want to highlight what we're seeing from a data perspective. And our approach will always be to follow that logic and try to remove that emotion from the portfolio. I can tell from experience, work with many clients today, they're on track. They've done very well over the past 5 years, the past 10 years. And as difficult as this environment can be, you don't allow 5 months to derail those longer term plans. And I'll talk about some of the indicators we're tracking and what we're seeing in the current markets. Then ultimately, what is the longer term plan? And what can you expect looking longer term from the overall market? So to start, we are in a midterm election year. The current slide looks back at the previous 18 midterm elections. Going back to 1950 through 2018, the average drawdown was around 17%. Your traditional year is around 13%. So from peak to trough, on average, it's around a 13% drawdown each year. It's about 30% higher in midterm election years. The market starts to price in potential change in leadership and from the current administration, very common for the current administration to lose seats heading into November. The silver lining, however, is looking longer term, the returns from those lows. So on average, you can see the performance looking 1 year out from the lows, those gains are in the neighborhood of 32%. The point being is, it is very common to see volatility in the midterm election year. We aren't caught off guard by the recent volatility, but recognize in each one of these previous cases, it has turned out to be an opportunity. Looking forward, there's two common questions we received today. It's inflation and it's interest rates. I want to touch on each of those and talk about how to be thinking about portfolios. Inflation is running high. We are at 40-year highs on inflation. And the current slide here highlights what some of the key drivers are. The gold is our focus. That's the transportation. So think used cars, autos, airfare. And year over year, you've seen, if you look back, obviously in 2020, 2021, very little travel. And the gold you can see was actually a detractor. It was a detractor to leading to lower inflation. Now it's a key contributor. When we're looking forward from here, there's no question inflation is likely going to run higher. But the common question we're receiving is we need to position our portfolios for rising inflation. Inflation can only go higher. Looking at the research, our expectation is while inflation is likely going to run above target, and the Fed, their target is 2%, it's going to run elevated, and they've already said they're going to allow inflation to run higher. We wouldn't position portfolios for rising inflation. It's run up very quickly, likely based on looking at energy, looking at food cost. There's pockets of wages. I would also include, there's pockets of inflation that are likely to be sticky. It will continue to lead to elevated inflation, but over time, you're likely to start to see inflation trail down and start to see a low, more disinflation over time. Part of the reason we're likely to see inflation to come down is due to the Fed. The Fed has made it very clear that they want to reduce, that they're going to be on a demand destruction approach. They really want to bring down demand. And frankly, that's really what the Fed can control. They can't change very limited policy in terms of what they can't change supply. So it's interesting though, is that the market's priced in a majority of the Fed rate hikes. The Fed, think of it as a gas pedal. They're trying to manage that economy by slowly how far they want to push on the gas or remove themselves from the gas. They've really been pushing the gas going back the last several years. In 2020 and 2021, they arguably pushed the gas too quickly between fiscal policy and monetary policy. We're now at a point that they're really removing themselves. And they're really trying to slow the economy. They've increased interest rates to right now 75 to 1%, but the market's already priced in many of their Fed hikes. The market right now, and this slide highlights, the gray highlights what to expect in December. So as of December, the market right now is pricing in 2.75. So right now, if you're positioning portfolios, it's not about rising interest rates through December. You have to base it on 2.75 because that's what's priced in. So the way we think about portfolios, kind of going back to that inflation conversation, the Fed is very concerned about inflation, very concerned about labor. There's too many job vacancies. They're going to try to bring down the job vacancies. They need to bring down inflation. But as we just highlighted, should inflation start to moderate and come down, could we see the Fed pause? Could they slow down the rate hikes? And could we see 2.75 drop to 2.5 or 2.25? When we're thinking about portfolio construction, I bring it up because many right now are thinking, when they're thinking about their portfolios, they're thinking about rising interest rates and rising inflation and recognizing we could start to see that turn because everything got priced in so quickly. And it was quickly priced into various asset classes. It was a very difficult return environment for fixed income in the first quarter. And we likely could see things moderate and actually truly be an opportunity over the near future, but would not be quick to position portfolios right now for rising inflation or rising interest rates. I want to finish with the fixed income slide, then talk about a little bit about longer term objectives and returns. This slide, little detailed, but you got an analyst, so you're going to see some slides with probably too many numbers or too many on graphics, and this is one of them. The blue highlights yield. This is just your short-term corporates. So right now today, if we're to go out and invest in short-term corporates, that blue line, you can see it's around 3.5%. If we would have had this same call 6 months ago in December, that return was closer to 1. Very low yield. When you have low yield, you have higher risk. Interestingly, the gray bars, though, they highlight what is your future return 3 years from today. So you can see how close those gray bars are to the blue. When you think about fixed income, it's much easier to predict than equity because the majority of your return comes from your yield. So if we were to sit 3 years from today, based on the information you can see, you're likely to be pretty close to that roughly 3.5%. And as you have higher income, you now have higher protection because you're getting paid more to wait. So when we think about fixed income today, the joke is you now have income in fixed income. Yields have increased dramatically over the past 6 months. We're getting paid more to wait. There's pockets of opportunities within fixed income, municipals being one, but also we have a much better starting point. And looking longer term, we've had a very difficult quarter. First quarter, I'd argue, very difficult start to this year, the worst in 40 years. But for clients that have that longer term perspective, we now are getting paid more on the portfolio. In addition, we can see that 3, 5, 10 years, the income's the key driver. We now have greater protection on the overall portfolio.
Angelo, when you talk about short-term fixed income, what's your definition of short-term?
1 to 3 years. 1 to 3 year corporates. Looking at the equity market and stepping back as I opened with just recognizing that we've had a very difficult 6 months, but do you position portfolios for 6 months or do you position them for a longer time frame? And our goal when we're making any trade in our portfolio, we're looking out in that 5 to 10 year time frame. This slide highlights if we invest today, what's the probability of positive returns? Over 1 year, we have a 75% probability of positive return. You can see 5 years, close to 90%. There's never been a negative period over 20 years for the S&P 500. While the likelihood of positive returns obviously increases over the longer term, the challenge for clients emotionally and behaviorally is the negative and the downside. So when you look at the potential downsides over that 1 year, that 25% downside, what is the dispersion? What is the range of outcomes? And looking at the range of outcomes, looking over 1, 5, 10, and 20 years, the green here highlights stocks, the blue is bonds, and then a 50-50 portfolio of 50% stocks and 50% bonds. Over 1 year, it's obviously very challenging, between 47% and down 40%. I would argue you likely shouldn't have stocks in your portfolio over a 1 year time horizon. But as we increase the time horizon, the range of outcomes is significantly reduced. Interestingly, over 5 years, a 50-50 portfolio has not had a negative return. Rolling 5 years, going back over 80 years. The point here highlighting that the range of outcomes are significantly reduced. And for our team, because we have a greater sense of what the likelihood of outcomes are, we take it, our approach is that 5 to 10 year time frame, looking for opportunities between international, between emerging markets, across large, mid, small, in US equity as well. But the point being is maintaining that longer term perspective. The 1 year volatility creates opportunity. The opportunity right now we're seeing in municipals within fixed income. You're starting to see volatility in the market, and for the clients are rewarded are those that can manage that volatility, maintain that longer term time horizon, and allow this volatility that creates opportunity be valuable looking over those 5 or 10 years and maintain that longer term focus and longer term objective. John, any questions thus far? And if not, I'd like to hop into. I'll talk
just a comment that for those of you who are clients, and there's plenty of folks on or who are not clients, we'd love to have you. That one of the reasons that we can have a long-term perspective is when we're doing planning for clients, whatever cash needs they have for about a 2 year period of time, we have set aside. Sometimes to the frustration of clients we could be, have those dollars at work, but they're there for a reason so that we can have a long-term perspective and hang in there and take advantage of exactly what Angelo is talking about here, being disciplined.
It's exactly right. And our approach is working closely with you as the advisor to understand each client. What do we need to be aware of? Where is there a need 1 year, 3 years from now to manage that liquidity, make sure that we have the right risk for that client. Absolutely right. So recognizing the current market environment, transitioning to how to be thinking about portfolio construction, going back to, especially for high net worth clients, how to be thinking about the overall portfolio. What is the right structure for in building out the allocation? Before selecting investments, it's important to have the right structure. And SMA, and Meeder probably will, the SMA is a separately managed account versus an exchange traded fund or ETF and a mutual fund. The separately managed account is the wrapper structure that is optimal for that high net worth investor. The reason is that that SMA allows for any position to transfer over in kind, whether it's an individual bond, interval fund, ETF, mutual fund. We've seen hedge funds. They can transfer into that SMA. Then from there, our team or any team can really determine what is the optimal investments to manage. How do you build out the right solution for the end client? I think it's very important. It gives control. For many high net worth investors, they're looking for control over their situation, control over their tax, control over their risk. By allowing each of these positions to transfer over in kind, there's no tax consequence. We can look across the portfolio to determine how to best manage the overall risk. The last line there is that holistic approach. And I'll touch on it in future slides, but it's very important now to it allows for individual stocks. And using those individual stocks provides that control, excluding a stock, excluding a sector, or more that flexibility going forward. But to start, in terms of managing that client, it's very important to have the right structure. And that separately managed account provides that structure to give the client the control to now offer the customization, risk management, and tax management. I'm going to touch on it further, but one of the most underserved areas of portfolio management is tax management. This is where you can add significant value to the portfolio. Going back to that SMA structure, by having the individual stocks, looking at the underlying capital gains on each investment, that SMA gives that control to manage the tax. That ETF, exchange traded fund, or mutual fund, you basically outsourced your control. Each of those funds are managed more for their own self-interest, less for the client. That SMA will allow for greater control in managing the underlying investments, controlling the capital gains. We have many clients that are providing a tax budget each year. Each year, we recognize for such more high net worth individuals, the tax needs may change year to year based on a variety of investments inside or outside the portfolio. Having that ability to manage through a tax budget for the client. A small value add is managing dividends and capital gains, allowing those to go to cash instead of being reinvested in the portfolio. The key, though, is now having the ability to do all these little things throughout the allocation to increase that after-tax return for the client. And I'll touch a little bit further on each of those areas that we provide value. So stepping back, the key areas we put focus on in building out allocations, one is around customization and getting away from that one-size-fits-all approach. Each client has a variety of different risks. I like to say the client's unique, their portfolio should be as well. Recognizing where those risks are inside or outside the portfolio, whether it's stock options, whether it's the spouse's 401k, an outside annuity, wherever that risk is, incorporating into the portfolio. The worst thing a portfolio management team can do is duplicate a risk the client has somewhere else. So the key is maintaining that open conversation with the advisor and client to understand where those risks are, and then properly accounting for those risks in the portfolio. And the only way to maintain that flexibility is using the right investments. Individual stocks for U.S. equity allows you to exclude a specific stock, possibly excluding a sector in the future should the client get more involved in real estate or whatever they choose to do. But the key there is having that flexibility, because we recognize that the solution we put in place today may be very different 6 months from now. And having that portfolio that can adapt and change as the goals, objectives, or risk of the client change. In terms of our day-to-day conversations and the needs of our clients, tax management and risk management are the most two common. I'll touch on tax management briefly. I have another slide to discuss it, but this is where you want to spend considerable time on taking advantage of, we call it tax loss harvesting or managing taxes. Similar to managing your own personal taxes with your CPA, you don't wait till the last week of December. You're implementing tax strategies throughout the year for your business. or just for your personal need. Same approach with investments. Tax management should be managed throughout the year and not the last 2 weeks of December. So our team's looking for opportunities, especially these past few months, where there may be an opportunity to sell Coke, buy Pepsi, sell Lowe's, buy Home Depot, harvest that loss. That loss can be used inside our account or outside of our account. But for clients, those losses create opportunity. You want to take advantage of them when they are available. From a risk perspective, I touched on managing around positions, having that flexibility to manage risk across the portfolio. And the last piece I'll touch on is investment management. At Meeder, we have a variety of different products, but it's very important from an investment management perspective to maintain a transparent, unbiased approach. No proprietary product in the solution. Truly manage the portfolio for the end client. Getting into a little bit of detail, then I want to walk through a brief case study, kind of talk through different moving parts that should be considered for high net worth clients. This highlights the mutual fund and why I brought up that transition from mutual fund to a separately managed account. We manage mutual funds at Meeder. This data is from Morningstar, public site, on highlighting what is the tax cost, not the expense ratio, just the tax cost to be in a mutual fund. And you look back over the past 20 years, it's about 1.6%. We use mutual funds. They're fantastic vehicles for many clients. For the clients who have the wealth, I'd argue you start to shift to the right. An ETF's a benefit. It does remove a majority of that expense. But the underlying structure of an ETF or mutual fund, they can never distribute losses to the end client. So it can never do better than zero. The advantage in structure as you shift over to SMA or separately managed account, now all the individual stocks are registered in the client's name. Google, Microsoft, Apple, Amazon, all registered in the client's name that you can harvest losses, exclude a stock, manage risk. And this is where tax management provides its value, that there can actually be a positive contribution to the portfolio by truly managing tax for the client. Another common example is if the client's taking withdrawals, looking longer term. Now to have 200 different stocks to review versus single ETF or single mutual fund. But putting numbers to it, we always bring up tax management. The common question is, sounds good, does it really matter? And I'd argue longer term, significant value, placing a focus on tax and having the ability to monitor that portfolio, where's an opportunity from a tax perspective, and having the opportunity in portfolio construction that there's a positive and there's an additive return, a tax alpha, if you will, versus a mutual fund or ETF in the overall allocation. Any questions there, John? Would you like me to continue talking through the prospect?
No, just on the tax front, that in essence, what we're trying to do is have Uncle Sam be less of a partner than they are for the average investor working with another advisor or doing it on their own, that they don't have the expertise that your team does to do this active tax harvesting.
Exactly right. It really comes down looking across all investments and what is the optimal structure to maximize after-tax return. And then in the end, that you're exactly right. It does nothing for a client to return 10% if we're losing 4% to Uncle Sam. The idea there is we want to figure out what is the overall tax drag, because there's going to be some, and we want to do the best to minimize that to the best of our ability, and hopefully implement tax strategies that ultimately add value to the overall after-tax return.
And beyond taxes, risk management is obviously very important, and for so many of our clients, for a whole variety of reasons, maybe because of their position inside a major corporation, whatever the case may be, they have a concentration of stock that they have to hold on to. They have no choice because of their position. And you've done a great job through the years of working around those situations, which for many of our clients, that is the case, in order to get where we're trying to go with the overall portfolio, being very flexible and working with us.
Yes, absolutely right. And I'll touch on it briefly on this case study, but we always start having that conversation with the client. As I mentioned, you can't come with a pre-built portfolio if a client already has a large concentrated position outside the account. So having that conversation, and there's two different approaches. One is the large positions held outside the account, and now we determine what stocks do we want to hold to offset that risk that's managed outside the portfolio. The second is, in many cases, a client, just given how strong the market's been, position transferred over in kind, we're managing it, And now there's a transition plan where we can harvest losses, use those losses to offset the gains in that concentrated position, and at the same time, add positions to offset the risk of that stock and possibly exclude other positions in the portfolio that are contributing to risk. So two different ways, not to get too detailed with it, but each situation is different on how you think about the overall positioning of the portfolio, building out that allocation. And in many cases, it's a transition plan. And as much as I'd like to say that that plan stays intact, we always find something new that the client brings, whether it's a change and they're buying a private equity, they're in a private equity investment, they're buying an outside company. But either way, there's a new risk we need to accommodate. And the most important piece, I'd argue, is for those longer term partners that we've worked 5-10 years with, it's having that ability to make those adjustments, that there's a new risk we need to consider to make sure we have that flexibility to manage around it.
You mentioned over time and with the years that we've been working with Meeder, when we brought on a new client and then we're working with their CPA, I love the response we get from the CPA on, wait a minute, here's what the client was paying on taxes in general in the past on these investments, and what's happening here? Are they not getting the return that they were getting? And then we go through, no, here are the returns. We're just doing a much better job than the client was doing or a previous advisor on the tax side. Those, like you said, the little things make a huge difference in the end.
No, exactly right. I'd like to say I present this material well, but once they meet with the accountant and the accountant shows me, I think in many cases the light bulb goes off and it's this is why I'm holding these investments. This is what drove down my 1099. Yeah. But yeah, you're exactly right. Once you go through meet with the accountant and go and see the decrease in the tax bill, it definitely all comes together. In speaking with John, we're talking through just different ways to show the different levers we can pull. Obviously, as we talked about, many different clients have different risk and being able to manage them. I wanted to highlight a recent prospect, and we're just highlighting our process, how we think about investing and recognizing many different risks that had to be considered and how we approach the situation. So this is a very common situation. Client has multiple accounts, whether it's IRAs, trusts, joint accounts, and they also have specific requests. When we think about specific requests, this is when I highlighted earlier, risk coming from outside the portfolio, wherever that risk may be. John talked about outside stock being held, whether it's a public or private company. How should we be thinking about that in the overall portfolio? And it could just be an outside investments, that outside Amazon holding in a brokerage account, whatever it might be. How do we think about that? Do we need to make adjustments in the portfolio? In this case, there was a large UPS holding, and truly understanding UPS and what we need to be thinking about in the overall allocation. Any outside concerns, philanthropic needs, income taxes, what needs to be considered. And then in this case, it was how to achieve a household risk of 60-40. And I bring that up because the simple way to do it is just make every account 60-40. The right way to do it is looking across all of these accounts. And how do I achieve that household risk with the least amount of tax cost for the overall client? So when in this situation, looking across the portfolio, many different accounts to think about, and many IRAs, obviously certain accounts that are IRAs are not taxable. The individual account, joint account is taxable. So thinking about risk and thinking about the right way to reach the allocation. In this case, where we wanted to reduce risk, if we could decrease the risk in the IRA, there'd be less cost for the overall client. In addition, if there's a large overweight in the taxable account, let's say large weight to Amazon, rather than selling Amazon, could I just remove Amazon from the IRA and no tax cost to the overall account? The point being is looking across these different accounts and kind of turning the levers to determine how can we best create the optimal solution, a clear financial picture for the client, and do it with the least amount of tax, but also achieve that overall risk objective at the household level. Quite a bit of work, a lot of back and forth, and in terms of building out that overall allocation, I think it's very important. This is where, kind of going back to where we started, putting more dollars in the client's pocket versus Uncle Sam's.
And in the situation, as I mentioned before, we're bringing the CPA in, so we're really working as the team proactively to make sure that we're looking at it from all our different specialties and disciplines to get the outcome that we desire and that the client desires.
100%. And I'd argue, yeah, we see in some cases state attorneys, we've seen bankers involved, bringing all those parties together to make sure that there's nothing missed. And we've created that optimal portfolio, that optimal solution for the client. Like I said, probably going to be a few slides with too many numbers. This is another one, but this is very important. I'm going to go back to that mutual fund story on various funds, fantastic funds. These are leveraged in other vehicles at Meeder. In this situation for this client, the argument was these aren't a good fit. And you can see the expense ratio for each of these strategies, kind of in that 30 basis points up to 0.5, almost up to 60 basis points. Last year, the capital gains, the way a mutual fund is managed is that capital gains are distributed at the end of the year based on the transactions that are performed within that mutual fund. Each of those mutual funds are managed for their own self-interest. So those capital gains result in a tax cost. For a high net worth client, the total cost to these strategies is the sum of the expense ratio and the one-year tax cost. So that American Funds Growth of America, it's 1.99, the one-year tax cost, plus the expense ratio, 0.3. I show this because when we opened around tax management, many clients focused on that expense ratio. I'd argue there needs to be greater focus on the tax cost. In many cases, it's a multiple of your expense ratio. And this is where the savings can come. By transitioning away from those mutual funds, let's use individual stocks, provide greater control, and do our best to reduce that tax cost, transition to individual stocks where now we have greater control. You've outsourced control here. There's no way, those mutual funds are simply letting you know what those capital gains are. If there are large redemptions, a large investor sells from that mutual fund, the mutual fund has to sell, you're now paying on those capital gains. In some cases, you're paying taxes on someone else's gains. So the key part of, when we're thinking about transition and structure, clients should own those individual stocks, take over greater control of the overall portfolio. The last point I'll just mention is that in red, the potential unrealized gains. This just tells what percentage of the overall, each mutual fund is unrealized gains. So if we were to invest today for American funds to start, 65 cents on every dollar is unrealized gains. So there's already embedded gains in the strategy. So should they have to make buys or sells within their account, likely you're going to see a tax cost in the future. And the reason we show that is just to give a gauge on, is a situation going to get better or worse for each of these funds?
Well, and just to be clear, that 65% unrealized gain, the client who's stepping into that situation did not receive any of the benefit at all. Someone else has. So in essence, they're paying someone else's taxes for them. It's a nice charitable gift to some stranger.
Exactly right. And it just goes back to structure. It's just a structure of that investment, and over time, those funds have done very well for decades, and now they've built up those unrealized gains. And this part of our strategy is to review these holdings to tell clients, where should we focus? If we're going to take a capital gain today, we recommend taking $100,000 in capital gains, why we're taking it and where we're going to focus. And if we're going to recommend a capital gain, we want to get the best bang for the buck. If it doesn't reduce risk or it doesn't improve your tax situation, it doesn't make sense to take the capital gain. So for us, it's providing this analysis, reviewing those funds to say which ones are providing a higher tax cost, which ones are likely to increase in the future. Let's make sure we move more aggressively out of those strategies and make that transition. Touching briefly on risk, and kind of go back to the case study we did, looked across all strategies, all investments to determine, is there overlap? And what we're trying to figure out is what other strategies are also holding UPS, or what other funds are also holding Microsoft. In this client situation, they already had far too much exposure to UPS. We were trying to set up a plan to transition away from UPS. But as you can see here, iShares, Vanguard, many other strategies were also buying UPS. There was no way for us to call each of these funds and say, listen, this client, we don't need UPS anymore. Can you remove UPS? So you can see this similar with Microsoft and Apple. It's very common. Our strategy longer term is to only own each of those tickers, to just own UPS, Microsoft, and Apple. Now we have control. We control how much exposure we have to that stock. We control how much exposure we have to that sector. These underlying funds are buying and selling. This is just today. It could be very different 30 days from now or 60 days from now. So the point being is by transitioning over those individual stocks, now we're taking over control of that account. We're taking control of that risk. We highlighted the benefit from a tax perspective, but really want to make sure that we're managing the underlying risk across accounts, especially if we're trying to make adjustments in that portfolio, especially in situations in UPS we're trying to transition out of that account, making sure that we're making that transition to those underlying stocks, getting away from that fund structure where it's very common to see significant overlap. Touching on allocations, just wanted to highlight here the overall exposure across each of the accounts. We wanted to get to 60-40. We were close, got closer to 70-30 in this case on the based on the total household. But the point being is each one of these accounts were very different. And we just saw the risk overlap. They weren't working with one another. In a true strategy, you want each of these accounts complementary. That one account may offset the risk of another account, or it may overweight a specific position or asset class that's underweight in another account. This account very different on U.S. exposure, very different on international exposure. The key focus should be at that household level. So what is the optimal structure, the optimal positioning to achieve that tax and risk objective of the client for the overall household? So in many cases, these four accounts may have slight differences across each, but it's very important that we achieve that household objective. And then going forward, each of the accounts are going to be slightly adjusted, whether it's an income need, whether there may be a large withdrawal. But the key is having these accounts working together to achieve that overall household objective for the client. And part that comes in a large part to having the right structure for the underlying investments to meet that objective, to have that control and have that flexibility, knowing that it's going to change in the future.
Angelo, if you could dig a little deeper, when you talk about an overall portfolio with a 60-40, 70-30 and looking at it holistically, understand that. But let's talk about why you'd put a particular investment inside qualified dollars, pre-tax dollars versus a taxable account.
Sure. So certain investments are more tax inefficient, and those investments may have a higher tax cost. So think whether it's corporates, floating rates, there's various fixed income strategies that are more tax efficient that would be better served in a qualified account. It's also very common from a risk perspective when clients want to reduce the risk. So we're going into our final 5 years. We're going to start taking withdrawals in 5 years. We want to start reducing the overall risk in our account. From a tax perspective, decreasing risk in that qualified account, or shifting more income producing securities within that qualified account, going to more conservative, more dividend payers, and leveraging that account to help maybe possibly offset that taxable account versus simply just reducing the risk in taxable account. So there's a combination of strategies that can be used. Dividend, obviously, you're going to pay a little bit of tax on the dividends. So that may be better served in the qualified account, especially within the fixed income side, whether it's floating rate, corporates, more tax inefficient investments, better served in the qualified account as well.
Great. And as you mentioned, it may be 5 years or more that we're looking ahead at what a client's income needs are, or maybe their risk profile is changing because of their life situation. It's not something we do overnight. We want to be very strategic and proactive about it.
Absolutely right. So doing the little things. And within U.S. equity, I touched on is using individual stocks. So making sure take control by having all the stocks registered in the client's name. We can defer short-term gains. We can exclude certain sectors. We can exclude a stock. You now have that flexibility by owning individual equities. Exchange traded fund or ETFs, they're made up of individual stocks, and many clients to sell that ETF may require a capital gain. We can look through that ETF. So what our team will do is we'll actually look at the underlying stocks in that ETF and then add stocks to offset it, but we may not have to take the capital gain on that exchange traded fund. Little detailed, but it's a little thing you can do that provides that just more value to the client, saves from a tax perspective. We can hold that investment, manage around it, transfer in kind, no issue, but being able to manage that risk without necessarily having to sell that investment. Reinvestment, we see many clients that they own a stock or they own a fund and they're reinvesting all the dividends and capital gains back into that investment. That stock is likely contributing from a tax perspective or from a risk perspective. So if that stock is already an overweight and it's best to start reducing it, the situation is made worse by ongoing reinvestment and continue to reinvest in that same strategy. It also creates unnecessary tax loss and may be difficult to manage. We recommend those reinvestments to go to cash, then from there managing around it. So sounds small, but these are just little things adding value ultimately for the end client. Mutual fund capital gain review. We touched on mutual funds and the underlying cost and what those capital gains, the capital gain cost will be. Capital gains come out in that neighborhood of September, October, where you get estimates on how much it'll actually cost the end client from a tax perspective. Our team will review those mutual funds to determine, should we hold this mutual fund or should we sell it now and have to pay that capital gain? So you're in a way whether you want to receive that capital gain or not based on that underlying distribution. So our team's going to perform that analysis just to confirm, is there anything else we need to consider? What is the optimal strategy for the end client? And then touched on wash sales. If you do to harvest a loss, you want to wait 30 days and you can't buy that in any other account. So part of our approach, as John highlighted, working with that accountant, working with the outside parties, making sure that we're properly managing across the accounts to avoid any wash sales, to make sure that we truly get that loss. So that's definitely valuable for the client. And then lastly, a tax budget. This just comes from having the right structure. If you have the right structure, now you can take control of the tax. And now determining what is year to year, what is the tax budget. We have many clients that, this is a great year, let's hold off. And let's push capital gains into the future. Or just simply right now, our conversation, the market's dropped. You know what? I wanted to work out of that mutual fund. Let's increase the capital gains since the cost isn't as severe as it was 6 months ago. And let's more aggressively start to transition. But the key is having that flexibility, and then working with the accountant, working with John, and make sure that we've properly positioned around the ultimate tax budget.
Angelo, when you're talking about the tax budget, you're the one who educated me, if you will, on a tax budget. It's like, well, we just need to do whatever we need to do. And of course, we're both smiling when we had the conversation, knowing that there's these people, these clients that have a tendency to get in their own way, and we're all human and we make subjective decisions. So coming around to that conversation of a tax budget, to accept that, okay, how much tax are we going to pay? For one client, it might make sense to pay the $100,000 or the $1 million of capital gains tax strategically. However, they're just emotionally, they can't handle that in one given year. So it's just accepting that we're dealing with us folks, and we need to do it in a way that a client is comfortable and we can still be strategic about it.
Exactly right. And this is the second bullet point there, scenario analysis, and having that conversation. And obviously each client's different on how they approach tax, being able to illustrate, is there advantage to take an extra $100,000 in capital gains this year? And what is the value? And our approach is recognized, as I've mentioned, we want to make sure there's a benefit from a capital gains perspective. And we're closely monitoring the risk. We provide a recommendation on how we would approach that. What is the overall value from a risk perspective on the overall portfolio? How much value add is achieved and across that allocation by increasing that capital gains budget? But you're exactly right. Being open, having that conversation, presenting those scenarios to determine what is optimal for the client.
Angelo, can we take a minute to talk about ESG's, environmental, social, government issues? It used to not be a topic that clients brought up, but it certainly is a conversation that we're having on a regular basis, and how you work in that area.
Sure. In our conversations with clients, we're finding that each client has a slightly different perspective on ESG, and which is fine. I think it's important. We always prefer to have that discovery meeting to determine where to put that focus, and to have that conversation on what should we be excluding. And in many cases for us, it's determining what should we exclude from that overall portfolio. We manage various churches with a few foundations we manage. So for our team, it's definitely a consideration and a conversation that we're having with clients. And I found that in each of those conversations, it's slightly different on what clients are looking for. So for us, we always approach that, having that conversation, determine how to properly structure that portfolio And the other point I'll mention is that clients have appreciated is that, especially for like foundations where clients may have a specific mission that they're supporting, letting us know what that mission is to determine what stocks may not support that mission, may actually be producing product or services that are counter to that mission, whatever that may be. So I think it's very important, as you highlighted, understanding exactly what that client's looking for or the organization's looking for, and then determining what is the optimal investments that should be considered in the allocation.
Yeah. Back at the beginning, you mentioned that each client is unique and their portfolio should be. That's a perfect example.
Exactly right.
And
so, yeah, bringing it all together here, just highlighting the overall approach in portfolio construction, how to be thinking about it. As you can expect from this short case study and our conversations, it's having that meeting, having that conversation with the advisor, in many cases, several conversations with the advisor, possibly the client or prospect, but just making sure you understand all areas of risk and tax, not only this year, but you have to understand it going forward so you can prepare on shifting that allocation. If it is going to start to shift, there's going to be a large withdrawal need. Don't wait 3 years and then make a radical shift, possibly start to transition over time. Incorporate that with the tax budget and understand what that tax budget will be over these next few years. Is there one year that's going to be worse than others? Should we move more aggressive and pull capital gains forward if we do have to make a large transition? Running the scenario analysis. Right now, we're doing a lot of charitable gifting and donor advised funds. So which specific stocks, this is gains, which specific stocks are best to donate to improve the overall risk of the portfolio? And once again, similar scenario analysis, but now gain harvesting versus loss harvesting, but looking at what is optimal if we want to transition $1 million out to a donor advised fund. But the point being is running that analysis, taking the time, make sure it's in line with the client's interest, and understanding any future risk over the near term that should be built into the overall allocation. And as we opened with, you got to do the little things, but do them right. And that's ultimately, that's reflected in that meeting with that accountant, that partnership with that advisor. And for our team, it's retention and making sure that we've built the right structure and built the right partnership, and we have that flexibility for clients longer term to meet their objectives.
Angelo, we had a question come in that we've been talking a lot about minimizing taxes, but the extreme situation that the client just brought up was, let's just assume everything's inside a qualified plan. Why work with Meeder? What are they going to do for me if it's not about taxes?
Sure. So on the qualified side, one, is there any outside risk we need to consider? And the overall plan for the assets for many of our qualified clients, that they're taking withdrawals. So we're shifting that portfolio towards income, towards dividend paying equities. And so slight tilt towards value, then fixed income, obviously higher yielding securities in the overall allocation. So still consider risk, and then also determine what is the plan for the overall assets, shift towards income. And then overall, from a portfolio positioning standpoint, our team can still make those adjustments. I didn't get much into some of the allocation changes, but our team will have that ability. We'll have the ability to look across U.S., international, emerging markets within fixed income. We've made several trades, especially recently within fixed income, where we're seeing opportunity. So we're going to look across asset classes across that portfolio to ultimately add value and hopefully incremental return for the client.
The words that I use quite often with clients in working with Meeder is control and flexibility. Control and flexibility. Life changes, and we can make moves that we can't make easily and as painlessly as we can with Meeder. Cheryl, it doesn't look like we have any other questions unless you see something that I'm not seeing.
No additional questions. I think you guys covered a wide breadth of things, so appreciate touching on all the subjects so thoroughly, and so that to the point that there are no additional questions. Gentlemen, I thank you very much. Thanks for putting this final slide back up. Just to let you know, we have 2 upcoming webinars, one in July on asset protection, another in August on women in power. So if you'd like As those registrations become available, you will see them on partnerswealth.com/webinar. There's John's contact information there if you would like to reach out with any additional questions regarding today's presentations or anything coming up, or what you would like to try to do with your portfolio as well. So John and Angelo, thank you so much. I appreciate you gentlemen being here. And I hope everybody has a great weekend.
Thanks, everyone.
Thank you. Appreciate it.
Okay. Bye.